How the rich avoid paying taxes. Taxation is a fundamental aspect of any functioning society, providing the revenue necessary to fund public services such as education, healthcare, infrastructure, and social security. However, the effectiveness and fairness of tax systems have long been subjects of debate, particularly concerning how much the wealthy contribute compared to the general population. While tax laws are designed to be progressive, meaning that higher earners should pay a larger share of their income in taxes, the reality often diverges from this principle. The rich employ a range of tactics to minimize their tax liabilities, taking advantage of legal loopholes, sophisticated financial instruments, and global mobility. Legal tax avoidance strategies, offshore accounts, and tax havens. One of the most well-known strategies used by the wealthy who avoid paying taxes is the use of offshore accounts and tax havens. Tax havens are countries or jurisdictions with low or no taxes and strict financial secrecy laws. Wealthy individuals and corporations can move their assets to these locations to avoid paying higher taxes in their home countries. Offshore accounts allow the rich to shield income and investments from taxation, often through complex structures such as shell companies and trusts that obscure ownership and the source of funds. For example, the Panama Papers leak in 2016 exposed how many wealthy individuals, including politicians and celebrities, use offshore accounts to hide their wealth and evade taxes. While holding money in offshore accounts is not illegal per se, failing to report these assets to tax authorities constitutes tax evasion. Even when reported, the use of tax havens can dramatically reduce tax liabilities, contributing to a significant loss of revenue for governments. Capital gains and investment income. The wealthy often derive a significant portion of their income from investments rather than wages or salaries. In many tax systems, income from capital gains, profits from the sale of assets like stocks or real estate, is taxed at a lower rate than ordinary income. This creates an opportunity for the rich to pay a lower effective tax rate than those who rely solely on earned income. For instance, in the United States, long-term capital gains are taxed at a maximum rate of 20%, compared to the top income tax rate of 37%. Wealthy individuals can also defer taxes on investment income by holding onto assets, only paying taxes when they sell. This deferral can last indefinitely, especially if they pass the assets to heirs through mechanisms like stepped-up basis, which resets the value of the assets for tax purposes upon inheritance, effectively erasing the tax liability on the gains accrued during the original owner's lifetime. Tax deductions and credits. The tax code is filled with deductions, credits, and exemptions that can be legally used to reduce taxable income. While these provisions are available to all taxpayers, wealthy often have more opportunities to take advantage of them due to their financial resources and access to expert tax planning. Common deductions used by the wealthy include those for mortgage interest on multiple homes, charitable donations, and business expenses. Charitable donations, in particular, can be structured in ways that provide significant tax benefits. For example, donating appreciated stock to a charity allows the donor to avoid paying capital gains taxes on the increase in value, while also receiving a deduction for the full market value of the stock. Similarly, deductions for business expenses can be used to reduce taxable income, sometimes in ways that blur the line between personal and business expenditures. Trusts and estate planning. Trusts are legal entities that can hold and manage assets on behalf of beneficiaries. They are a popular tool among the wealthy for estate planning and tax avoidance. By placing assets in a trust, individuals can reduce or eliminate estate taxes and ensure that wealth is passed on to heirs with minimal tax liability. Various types of trusts, such as grantor retained annuity trusts, GRATs, intentionally defective grantor trusts, IDGTs, and dynasty trusts, are specifically designed to exploit loopholes in the tax code. For example, a GRAT allows the grantor to transfer assets to heirs at a reduced tax cost, while a dynasty trust can protect wealth from estate taxes for multiple generations. These strategies can result in significant tax savings and perpetuate the concentration of wealth within families. Corporate tax avoidance. Corporations controlled by wealthy individuals often engage in tax avoidance strategies that reduce the overall tax burden for their owners. For example, multinational corporations like Apple, Google, and Amazon have been scrutinized for their use of complex structures that allocate profits to subsidiaries in countries with favorable tax regimes, even when the economic activity generating those profits occurs elsewhere. This practice, known as profit shifting, allows companies to significantly reduce their tax bills while still benefiting from the infrastructure and services provided by the countries where they operate. The widespread perception that the wealthy do not pay their fair share of taxes undermines public trust in the tax system and government institutions. When ordinary citizens see that the rich can legally avoid taxes while they themselves struggle to make ends meet and fulfill their tax obligations, it breeds resentment and a sense of injustice. This erosion of trust can have far-reaching consequences, including reduced compliance with tax laws, decreased civic engagement, and increased support for populist movements that promise to challenge the status quo. The perception of inequality in tax contributions also fuels political polarization and complicates efforts to achieve consensus on fiscal policy. Tax avoidance by the wealthy exacerbates economic inequality by allowing them to accumulate and preserve wealth more effectively than the rest of the population. The tax system, which is supposed to be progressive, becomes regressive in practice when the rich pay a lower effective tax rate than middle and lower income individuals. This growing inequality has social and economic implications, including reduced social mobility, increased political influence for the wealthy, and a concentration of economic power in fewer hands. Inequality can also hinder economic growth by limiting opportunities for a large segment of the population and reducing overall demand for goods and services. Impact on government revenue. Tax avoidance by the wealthy leads to significant losses in government revenue, which in turn affects the ability of governments to fund essential services and invest in public goods. When the rich avoid taxes, the burden of funding government operations shifts to the rest of the population, often resulting in higher taxes for middle and lower income individuals or cuts to public services. This underfunding of government programs can have long-term consequences, including reduced access to quality education, healthcare, and infrastructure. It also limits the government's ability to address social issues like poverty, homelessness, and environmental sustainability. Solutions and reforms, closing loopholes, and strengthening enforcement. One of the most straightforward ways to address tax avoidance is to close the loopholes that allow it to occur. This includes tightening regulations on offshore accounts, revising the tax treatment of capital gains and investment income, and limiting the use of trusts and other estate planning tools for tax avoidance purposes. Strengthening enforcement is also critical. This involves increasing funding for tax authorities, improving data sharing between countries to combat offshore tax evasion, and imposing stricter penalties for tax avoidance. The introduction of the global minimum corporate tax rate, as proposed by the OECD, is one example of a policy aimed at reducing profit shifting and ensuring that multinational corporations pay their fair share of taxes. Tax reform and progressive taxation. Comprehensive tax reform is needed to make the tax system more equitable and ensure that the wealthy contribute a fair share of their income. Progressive taxation is based on the principle that those with greater financial resources should pay a larger share of their income in taxes. This not only helps to reduce inequality, but also ensures that the government has the resources needed to fund public goods and services. Reforms could also include revisiting the structure of tax deductions and credits to ensure they benefit the broader population rather than just the wealthy. Public awareness and advocacy. Raising public awareness about the issue of tax avoidance is essential for building support for reforms. Advocacy groups, journalists, and policymakers can play a key role in highlighting the ways in which the wealthy avoid taxes and the impact this has on society. By educating the public about the importance of a fair and effective tax system, it is possible to generate the political will needed to enact meaningful reforms. Grassroots movements and campaigns that demand greater transparency and accountability from both individuals and corporations can help shift the balance of power and create a tax system that works for everyone. This finishes our today's video. Share your thoughts on this in the comments section below. Also subscribe now for more. Thanks for watching.